Well, hey, Johnny Dean here with Professor Rick Plum. Okay, I told you, I warned you. I said, Gene Pastula, you're going to have to explain yourself, my friend. So I ask Gene every morning, by the way, Johnny Dean, Professor Rick Plum, Bucket Strategy Investing. Gene Pastula, our resident insurance. Can I call you an expert? I just did.
Go ahead.
All right, I did.
Yeah.
All right. You've been working in it when you've been doing it as long as you have.
I've met a lot of people that don't know as much as me about it. So.
Okay. Well, there you go. You see, he's got
See?
the confidence that is required. Yeah.
That's a good way to say it.
I should just have you do your own intro, you know? Anyway, Gene Pastula, Brain Trust member, long time Brain Trust member here with us. And I asked you this morning, or you told me this morning what you wanted to talk about. You said, how's this? How about this line for you? How does this grab you?
He sent it to me.
Stock market returns without the risk. And so I had to go tell Plum. I went running down the hallway, waving it above my head, saying, guess what Gene wants to talk about? And
he is not going to sit next to me and make that statement. That just doesn't work.
So Gene, you'll have to explain yourself what you mean by this.
Well, I guess we got the compliance issues out of the way, didn't we?
There you go. All right, so
Okay,
we've heard this many times.
Right, exactly, and then that's the thing. I mean, you hear about it on the radio. I don't think you see much of it in print anymore. I mean, when they were first doing this, you would get letters, you know, direct mail letters and cards and what have you, and inviting you to seminars to see how you could, you know, perform in the stock market without any downside. And now those are gone because nobody wants to put this in writing, but they do talk about it on the radio and what have you. And what they're referring to is the insurance industry's capability, discovery, if you will, maybe even, a number of years ago, of ways to increase the amount of interest that they pay on things like annuities and cash value life insurance and what have you, and still make it safe and provide guarantees and what have you.
And still make a profit.
Always make a profit, yes. You want that. You want them making a profit. That way that you know that
they're still in business when you need the claim.
That's right, that they'll be able to honor their promises. So, but what this really applies to is a strategy where they're incorporating derivatives, puts,
calls,
options, yes, into their normal portfolio of bonds. And by doing that, when the market is actively strong and increasing and what have you, they can actually derive a little bit more money in their portfolio so that they can pay an interest rate to you inside of whatever contract that you're buying at a higher rate than they might otherwise with just bonds. All right,
just a safer portfolio.
Yes, exactly. And of course, the key is that once that money is credited each year, it's guaranteed in the portfolio. Nothing's going to happen to that based on any kind of market activity. So therefore, and of course, if the next year the market does better than it did last year, the likelihood is that your interest rate that particular year is going to be a little higher. And I personally have seen this in accounts that my mom had for a number of years, very satisfactorily, where we'd see the interest rate, you know, not a whole lot, but you know, half or 1% higher.
We need to say what we're talking about.
Okay,
here.
well, all right, so. Yeah, I'm getting to that. Okay.
Well,
but first of all, you need to understand that we're going to talk about putting money in an insurance contract or an annuity contract to grow or to provide benefits that are what most people say is too good to be true. I did 2 seminars last week, and in both seminars, the first thing that came out of the mouths when it was time to ask questions or make comments was, this sounds too good to be true. And so the reason that they do this is all based on math. I mean, the things that they can do, the promises that the insurance companies make to you, whether it be to pay a death benefit to your heirs or a long-term care benefit to the insured or an income benefit to the annuity, annuitants, they're all based on the math that involves the earnings that they can get on the money that they can pass on to your contract and the cost of the benefits that they're providing.
So what they got to do
along with some profit for them.
What they got to do is take your money that you're giving them and go out and try to earn something
And
better.
do something
That's what it is. And if they
with
earn
it.
something a lot better and they
Right.
still have enough left over, they'll pass the earnings on to you.
Exactly. And when we look back and we see what those earnings are using this strategy that I just mentioned, we see that they're very respectable, that, not too many disappointments on those.
Now, respectable is a relative term, and we have to go into these types, any type of product, with a realistic assumption, a realistic expectation. And so what we started off the segment talking about, stock market returns with no risk, that's not a realistic expectation of return without risk. So when we're talking about a reasonable rate of return, we're talking about, maybe a half point to a point higher than what you could get on a bond portfolio or something else.
I just checked with my annuity guru
Okay.
before I walked in here, and I asked them, because what they do is they say, we will give in any given year, typically 100% of the increase in, for example, the S&P, the most common index they use, up to a cap. And of course, the cap is the operative word there.
Cap is
all right?
is the issue.
And I'll talk to you about caps that are in the 11% category as well. But in this case, in typically right now, I said, what is the average cap? And he says 4.5% to 5.5%. 4.5% to 5%, 5.5%, with no risk like you have in a bond.
Right.
Okay. And no downside if things get bad next year, or the interest rates in environment changes. Yours stays right there, and only goes up if the market goes up. So that's the kind of thing we're talking about.
When we talk about no risk, we're talking about no risk to the principal. That 5.5 is not a guaranteed annual rate of return. It's up to that, and the principal is guaranteed. The interest rate is going to be variable, somewhere between 0 and 5.5%, based on what that index does for that measuring period.
If you use a proper advisor who has access to a variety of carriers and products that can help you select the one that gives you as much of the features that you're looking for as possible, you're more likely to be able to get one of the best levels of crediting rate. He said 4.5 to 5.5. That means that he knows of, and he mentioned it to me, a carrier that did 5.5, but he also knew one that was 4.5.
Right.
And so, so there are differences. But you still might pick the 4.5 for some other benefit that was involved.
It may have another bell or whistle that you like.
So as we go to a break here, what we're talking about, and we'll tell you what it is after the break, is a particular type of product that could potentially give you 4.5%, 5%, something like that, with no downside risk to the principal.
Correct.
The 0 is guaranteed.
Yes.
Anything above that, up to 5% or 4.5%, whatever it is gravy that's potentially there. So we'll talk about this with Gene Pastula. You're watching and listening to Bucket Strategy Investing. Johnny Dean, Professor Rick Plum, and Brain Trust member Gene coming back with more right after this.